Home prices are rising, but for all the wrong reasons. Earlier today, Case-Shiller Home Price Index was reported. What we're going to show you is that the numbers on the surface look fantastic. Unfortunately, they're going up for the wrong reason. Now, the Case-Shiller Home Price Index measures the change in the value of U.S. single-family homes on a monthly basis. It was reported the Case-Shiller Home Price Index now is at a level of 317, following last month's 313. These are all-time highs for this index. On a month-over-month basis, it's the second month in positive territory, up 1.3%, following last month's 0.7. That looks good. The Case-Shiller 20 City Home Price Index, that's also up in positive territory for the second month, 1.6% versus last month's 0.9. Prices are rising, but not for the right reason. Why do we say this? Home prices reached new highs in March, fueled by scarcity. This is reported on MarketWatch. Home prices in the 20 biggest U.S. metros hit another all-time high as the housing market remains hampered by a low number of properties for sale. The housing market's like any other market. It's supply and demand, and there's just no supply. Why are inventories so low? The answer, the lock-in effect. We've spoken about this in the past. So we went through a period of very low interest rates, 2017, 18, where a lot of us bought homes. Now we had a very rapid rise in interest rates. And now all those homeowners, I should say, that may want to sell have decided, no, we're not going to sell, because if I sell, I'm going to roll myself into a brand new, very high interest rate mortgage. So they're essentially locked into their homes. That's why inventory is so low. Now, existing home sales, this is the monthly supply. We spoke about this last week. The current level is 3.5. What does 3.5 mean? It's 3.5 months of inventory. If we were to sell all the existing homes on the market right now, it would take 3.5 months to get through all the inventory. 3.5 is a very low number. We typically want to see levels around 6 or 7 months of inventory. A high number would be 9. 3.5 is very low. Purchase-only house price index. This is another indicator as reported today. It measures the changes in the housing market released by the Federal Housing Finance Agency. If you dig below the surface, which we have, you're going to find it's going to be quite interesting. The house price index, this is on a year-over-year basis. These lines are trending to the upside. In particular, the three strongest sectors include the Middle Atlantic, New England, and East North Central. What are these areas? Middle Atlantic division is New Jersey, New York, Pennsylvania. New England, Connecticut, the rest of the New England states. East North Central division, Illinois, Indiana, Michigan, Ohio, Wisconsin. Why is this important? It is. We're going to tell you in just a second. These are the three weakest areas of the house price index on a year-over-year basis. Pacific, East South Central, West South Central. Pacific is Alaska, California, Hawaii, Oregon, Washington. East South Central, Alabama, Kentucky, Mississippi, Tennessee. West South Central Division, Arkansas, Louisiana, Oklahoma, Texas. Okay. Now, last week, and now we put this all together. Last week, it was reported the new homes sold. Now, when they report the new homes sold, they break the country into four major categories. The bright blue line at the top, those are the homes in the South. The yellow, the West. Red, in Midwest. Purple at the bottom, that's Northeast. Notice the purple in particular. That's all the way at the bottom. That's the Northeast. That's New England, New York, Jersey, etc. That line hardly moves. It doesn't move at all. This chart, by the way, goes back to 1999. Notice that when we have very strong markets, the other lines are a lot more volatile. The homes for sale, or I should say the homes sold in the Northeast, are actually not indicative very much of the state of the U.S. economy, relatively speaking. We can't gain a lot of information about the state of the economy by looking at the homes for sale, or the homes sold, I should say, in New York and Boston. Now, amazingly enough, this purple line correlates with some of the strongest sectors in our house price index that was reported today. Remember, the house price index, the white line at the top, that's a Middle Atlantic. The house price index in red, that's New England. And then, of course, yellow, the house price index for the North Central. So the areas of the house price index, the strongest sectors in the house price index reported today, correlate with that purple line, the new homes sold, which is actually not very indicative of the US economy. It's not volatile at all. On the other hand, the bright blue line, these are the homes that are sold in the South. And it is very volatile and it is very representative, we should say, of the US economy. Take a look on the left hand side, 2000 through 2004 5, when the housing market was very strong. Those southern states, those homes sold, the value of those homes sold really went up a lot. In 2008, 2009, when the economy got itself in a lot of trouble, that line went down a lot. It went down more than any other line. And that's very, again, representative of the US economy. If you wanted to pick one line that seemed to represent or track the US economy, it would be the houses sold in the South. Well, the houses sold in the South correlate with some of our weakest indices that were reported today. Now, the purple line, I know that's the house price index in the Pacific, Oregon, Hawaii, put that aside. But then we have the blue line, right hand side. That's east, south, central. Those are the states in the southeast of the country. And the yellow line, the west, south, central, the states in the southwest side of the country. Point being, and this is really the point of all of this, is that the weakest sectors in the house price index most closely correlate or are represented by that blue line on the left hand side, which most closely correlate, historically at least, with the US economy. If you wanted to see which way the US economy was going, you'd look at the homes sold in the South, that blue line on the left hand side, which happens to, at least for the most part, correlate or represent the weakest parts of a house price index on the right. It's a working theory. Let us know what you think in the comments, if this holds any water. But the contention basically is that the new homes sold, which seems to be most closely linked to the U.S. economy through the booms and the busts, is also linked to the weakest part of the housing market right now. By the way, if you want to hear more about this, we put this all together. It's circled in red here. How housing inflation is pricing out the average buyer. Now, prices are rising, but not for the right reason. We spoke about the low inventories, but there's also inflation. Home prices have been skyrocketing as a result of inflation. We're going to learn a lot more about inflation in just a couple days. This week's economic calendar is probably one of the most important weeks we've seen in recent past. Today, of course, we spoke about the S&P Case-Shiller Home Price Index. We also have the Fed's Beige Book, which is basically a window into what the Fed is thinking in terms of whether they're going to cut interest rates or not. We spoke about this recently, that the Fed does not have all the time in the world to decide whether to cut rates because we're in an election cycle. And they can't cut rates too close to the election because that would appear to be maybe political. Well, that's what we spoke about in our report yesterday. We also have GDP. That's a huge number. And of course, a PCE, personal consumption expenditure, our inflation level. And that's going to tell us a lot about which way the Fed may be looking as well. This, of course, was all discussed during our market watch this week. And I think you'll find what we discovered here to be quite interesting.